How are you, folks? Enzo DiCostanzo, clinical professor of economics and finance in St. Peters, in Jersey City. And today we're going to be talking about the head of household, filing status, personal exemption, and actually what happened with the Trump, the 2017 change in the federal tax legislation. And we're going to work out an Excel problem. Okay. Okay. So the first thing we're going to talk about today is head of household and that filing status. And I'll tell you, after reading this, I have to ask my tax preparer why I'm not filing is this. But anyway, that's for another day. May file returns as head of household if they're unmarried, pay more than half the cost of supporting and housing a qualifying person. And you have to go into this whole qualifying person definition. That would be, I guess, the 501. And let's see. That there's the definition for a qualifying person's got to be in there. And yeah, I should have had this open. Sorry about that. And let's just go to search. Let's see how many times we get this. So yeah, this is for head of household. And it says you may be able to file as head of household if you meet the following requirements. You're unmarried. Okay, so yeah, this is where the notes came from. Consider unmarried the last day of the year, paid more than half the cost of keeping up the home for the year, and a qualifying person lived with you in the home for more than half the year, except for temporary absence such as school. If the qualifying person is your dependent parent, or the person doesn't have to live with you. And it said there's some special rules for qualifying persons. And let's see, home of qualifying person. No, yeah, that doesn't apply to us. Here, it says see table 4 to see who's okay. So yeah, so there's this here. It says who is a qualifying person to file as head of household. So this is where those notes came from. And again, I didn't necessarily assign the reading of this doc, but it's good if you read this. So, okay, so to see the text of the publication for the requirements, you must meet to claim the head of household filing status. If the person is your qualifying child, qualifying relative who is a father or mother, it says you can claim him or her as a dependent. It says if you do claim them, then they're a qualifying person, and if you don't claim them or you can't claim them as a dependent, they're not a qualifying person. Okay, so I think it has to do with the rules of dependencies. And it says qualifying relative other than father or mother. That one doesn't apply to me. And then there's some other details here for number 5. It says if you can claim the person as a dependent only because of multiple support agreements, the person isn't a qualifying person. Okay. And then you can see, but there's a lot of logic in here. Okay, there's a lot of logic in all this. And here, let's go to who is and is not a dependent. Yeah, dependents. Here we go. Means qualifying child, qualifying relative, and there's some other definitions of a qualifying child, definitions of a qualifying relative. So 4 tests, very legal 4 tests that must be met for the person to be your qualifying relative. They're not a qualifying child test. They're not a qualifying child, member of the household, or there's a relationship test, gross income test, and the support test. Okay, so you have 4 of those. So a child isn't if the child is your qualifying child or the qualifying child of another taxpayer. So, and there's a couple examples here. Okay, so you have that. Member of household or relationship test is this one. Lives with you all year as a member of your household, but related to one of the following ways, listed under relatives who don't have to live with you. So yeah, and your child, father, mother, grandparent, stepfather. Okay. There's a gross income test. To meet the test, a person's gross income for the year. Yeah, I guess that's why, because mom's gross income is above that. Okay. There's a gross income. I guess that's why we're not doing it. And then the support test. It says to meet this estimate, should provide more than half the person's support during the calendar year. Now, again, we're just sort of skimming these, but you can see there's a lot of examples here, medical expenses and fair values and things of that nature. So, get it, folks. Let me tell you something. Get into this. This, like I said, people will pay you to do this, and we're going through it in a college course and all that. So, people can pay you to do this. So, keep that in mind. Okay. So, anyhow, yeah. So there's more detail than my notes have here, but and you can see there's a little bit of a summary here. Taxpayers eligible to classify themselves as head of household get a higher standard deduction, lower tax rate than taxpayers who file a single or married. So that's why you if you can, but your dependent has to have below that 4,300, and mom's pension is above that. That's probably why. So anyway, to qualify for head of household, tax filing status, you must file a separate individual tax return, be considered unmarried, and have a qualifying child or dependent. Then the person who's your qualifying parent or dependent. The qualifying person must generally be either a child or parent of the head of household, and they file their own tax return. The head of household must pay for more than half of the qualifying person's support, and the filing status is available to taxpayers who meet certain qualifications. File separate individual tax returns, unmarried, qualifying dependent, child or parent, and pay more than one half the cost of supporting the qualifying person and more than one half the cost of maintaining the qualifying person's primary residence. And it says, provides a breakdown in Table 4, which we just looked at in Publication 501. And these are some of the conditions to be considered unmarried, single, divorced, regarded as unmarried. And there's an example here. Don't live with the spouse during the last 6 months of the tax year. The status further requires that the head of household meets either of these two requirements, is married to a non-resident alien whom they elect not to treat as a resident alien, or the head of household is legally separated. Okay, so under divorce or separate maintenance decree, but the decree is something the court issues. So married taxpayers are considered unmarried if they have not lived with their spouse for the last 6 months of the year. There was a student who played this game. She was in like the Marines or something, and she said, I didn't talk to my husband for a couple of years. And I was trying to figure out what was going on there. But anyhow, so I think they got back together somehow. Anyway, so financially supporting a qualifying person, paying for more than one half of the cost of qualifying person's support and housing costs, pay more than half the rent, mortgage, utilities, repair, insurance, taxes, other costs to maintain the home where the qualifying person lives for more than half the year. The home must be the taxpayer's own home unless the qualifying person is a taxpayer's parent and the home is a property of that parent. If the qualifying parent person lives in another address, it's possible to file as a head of household, providing they're dependent on you and you cover more than half the cost of keeping up their home. Yeah, so this I didn't necessarily go over the Tax Cuts and Jobs Act, but I have to go over that eventually. But because I was hesitant because it's probably a significant piece of legislation. Let me see how long that this act is. Uh, yeah, it says the largest set of changes to the revenue code since 1986 when Reagan was president, and it says to see the text. Click here. Yeah, okay. This is the PDF of this. And let's see how long this is or how big this is. 185 pages. That's why I was shying away. I could teach the course in this. Okay, 185 page legislation. 2017, he got this going. So when did he get in? Okay, so I think he started doing this right away. 17, 18, 19. Yeah, so this was pretty fast, right? This was pretty fast. Oh wait, when did he? It was when was that election? That election was in 16, right? Yeah, I think it was. I was watching the. Yeah, when did he get out? So 20, 19, 18. Okay, so this thing almost immediately, this thing was up there. But wait, 20, yeah, 2017. It's his third day of January. Well, for the budget of the fiscal. So this was started before he got in there. They probably renamed it, but this thing was started before. If taxable income is, and then they give the different percentages here. Yeah, these are the federal tax rates. It starts with that. And then it goes on, but like I said, it's a lot of pages, that's why I would even though you can see the text is rather narrow, but folks, spend a little bit of time looking at stuff like this, with the tax code and the legislation, and now this only I think this only is gonna last until, 2025 or something, yeah, along there, so it's this stuff is it's not forever, this stuff is not really it's rarely forever, this stuff. There we go. Yeah, it's rarely forever, these things, but, yeah, these things are rarely forever, but so there was a personal exemption, and we're going to discuss that next. It says the head of household filers had to be able to claim an exemption for the qualifying person, could release their exemption to a non-custodial parent in a divorce proceeding or a legal separation agreement and remain eligible. So yeah, there's a lot of complication with this. It says some examples of filing as head of household. Somebody makes 70,000 a year. And then what's the other parts of this? It says, yeah, there's a comparison here of head of household versus single or married filing separately. Um, head of household has a standard deduction, and if you again, I hate to just do the math on the fly like this, but if you subtract 18,880, you're going to get 51,200. I didn't sit there and do the math on the side, but that's 20,000 minus 70 is about 50, so you're about 1,200 away from that. So now taxable income is reduced because there's a standard deduction. So instead of paying tax on 70,000, you're paying tax on 51,200, and then from that amount, the different brackets, 14,000 is tax at 10%, 37,000 is tax at 12%, bringing the tax bill to 5,860. Um, that's a good one to work on. Do we have that worked on? Let me check and see if I have that worked on. Oh yeah, we do. Okay, yeah, that's what we're working on. Okay, yeah, we're gonna get to that in a second. Sure, we are working on that. That's next. Good. So yeah, and then what the tax bill is, and then there's a comparison. So I looked at this for 2021. I looked at this for 2022. If you're married, if as a taxpayer filed single or married filing separately qualifies for standard deduction of only 12,550, which is less than the standard deduction up here. Taxable income instead of being 70,000 is 57, which is higher than the 51,200 here. So of the 57,450, and then we break it up, 9,950 is 10%, 30,000 is 12%, 16,000 is 22%, right? And you add up the tax bill. Again, it's in text form. So filing as a head of household saved this hypothetical taxpayer a couple thousand. So these are the computations, and you can't just wing it or just do it in the air. You have to sit down with a spreadsheet and work through those examples. So for the 2022 tax year, the savings will increase as the income limits are adjusted for inflation. Standard deduction rises to some different numbers and things of that nature. Okay, the single filer or the head of household deductions might change, and there's a couple questions here. Who qualifies as head of household? Is it better to file as a single or head of household? What is the standard deduction for head of household? So there's some just very standard boilerplate questions there that we're going to go over. So yeah, it says yeah, we're gonna do yeah. So this is what we're gonna post when we get online. So to file taxes as head of household, you must be considered unmarried, pay at least half the household expenses, have either qualified dependent living with you more than half the year, or a parent for whom you cover half of the housing costs. Is it better to file as a single or head of household? For tax purposes, it's better to be head of household. Head of household filers have a lower tax rate, higher standard deduction than single filers. So again, you're doing these comparisons, which we're going to work on in the week coming up in October. In 2021, the tax year, the portion of income not subject to tax for heads of household is 18,880. In 2022, the threshold goes to 19,400. So let's check those standard deductions. We worked on that early in the course, right? Yeah, there's standard deductions there. This is for who and for what. This is single, married, filing jointly, head of household. So yeah, 18,880 and 19,400. Yeah, those are it. Okay, so if you look at those, and again, we reference those early on, I think, in the course. A couple different places that you can look for those. Uh, you could do the instructions, the 1040 instructions. That again, this is posted for you guys on the Blackboard side. But you can go to what do you call it? You can go to the IRS site yourself. Oh, pardon me, folks. These are Schedule A instructions. That's not what I wanted. Schedule E instruct. Here we go. We wanted the 114 pages. Sorry about that. The wrong. Yeah, when you have a lot of these documents, right? There we go. So this is for head of household. This is for 2021. It's 18,880. What do we have here? 18,880. What do we have here? 18,880. Okay. And there's the 2022 version of this that we have to sort of dig through a little bit and have to recall where that was. Where was that? Yeah, one of these had 2022 um, numbers in it. We know the instructions are here, though that we know, but it was something in here that had 2022 numbers in it. Was it the IRS stuff? IRA? No, that's for 2021. Okay, this is 2022, but that's not helping us. This we're here already with this. Here, I think it's this one. Yeah, this is 505, and it says how to pay, when to pay, how to figure estimated taxes. All right. I see standard deduction, some thresholds. These are the rates. Yeah, this is 505. I'm just gonna, if you guys don't mind, I'm just gonna rename this a bit. This is 2022. Okay, so we can recall doing that, and this is deduction. Yeah, here we go. So head of household 19,400. Right? What do we have here? 19,400. And what do you have here? Okay. So I just showed you where all that stuff comes from. And that's folks, that's important. I know it's oh, why it's so monotonous. You're going through all these details. Well, I mean, that's this job is to make sure that you've checked all your boxes. And this will come in handy working like this and doing this sort of believe me, this is a combination of economics, legal, accounting, finance, statistics. It's a Excel training. You're getting about 4 things in this course. That's why it seems so daunting. Okay, but that's a worthwhile, useful thing. I know it's challenging. I know that. But that's okay. That's okay. Challenging is good. It's good to be challenged now than later. And here with the personal exemption, we've lost this, but we're going to just quickly discuss it. And it says personal exemption was a federal income tax breakup until 2017. The Tax Cuts and Jobs Act eliminated it for whatever many years that is, 7 years or something like that. So actually 18, 19, 20, 1, 2, 3. So it's 8 years, right? It's not 7. It might seem like 7, but it's the complete year, so it's 8 years. The exemption was earmarked for subsistence level of income, which was untaxed, and gave an exemption for each person the taxpayer supported. The taxpayer could claim the personal exemption for themselves, or spouse, or qualifying dependents. It was 4,050 in 2017. I think that was the last time that we looked at it. It says there's no personal exemption for 2018. So this is why you're paying a tax person. I'm teaching this course with you, but if I change what we do next year, next semester, whatever it might be, or I'm not on this topic again, I'm not going to be as up on the changes. And there are changes with changing administrations, there are legal changes in this. So you need someone who's current with what has changed. And usually, if you look at the beginning of a lot of these documents, it'll tell you what has changed. I'll have like a little what has changed a paragraph. See what's new? Who must file, standard deductions increase, charitable contributions deduction. It'll say to you what's new at the beginning of all of these IRS publications. So, like I said, folks, this is all free. It's a free textbook into how to do all this, right? So I think this is pretty good. I think this is pretty good to take a good look at this. So, new tax legislation for most taxpayers is doubled for that period. Yeah, but the standard deductions doubled or changed. So the hardship eliminates the need for me to itemize deductions. So there's some. I think streamlining is the word. I think streamline. I would say streamlining is the word for what's happened here. That's pretty good. So like I said, so if you have actually, I'm going to upload this. Okay. Yeah, a large set of change to the revenue code signed into law by President 2017. Made many large changes across multiple areas of the tax code, including the reducing the corporate tax rate, increasing standard deduction, increasing applicable exclusion amounts for estate taxes. Some of the changes were permanent, and over 20 provisions will expire by the end of 2025. It reduces the tax brackets from these numbers to these lower numbers. So you have 39 after 37, 32 from 33, 24 from 28, and on and on and on. Okay, and there's a whole bunch of other detail with this, but there's some how corporations were taxed for internal income. So actually, you know what I'm gonna do? I like how Cornell put their stuff together. So I'm gonna throw this here, and if you guys don't mind for a second, page 20. Yeah, here. This is the Trump thing. Okay. That's for later. We'll do a little bit from the Cornell. When I was at Queens College, we used a lot of that. It's the Cornell website. It was good. It was good. It was free. It was accurate, up to date, and it goes through a lot of the detail of this. Like I said, I wasn't planning on going over this today, but we're gonna use this at the time. So okay, we're here. So go page 20. We were here last time. We stopped here. So yeah. So higher standard deduction. It says the personal exemption was available until 2017, but eliminated for the next 8 years. Taxpayers, their spouses, qualifying dependents were able to claim personal exemption. It was eliminated as a result of the Tax Cuts and Jobs Act. Fine. And says the personal exemption was figured by counting up all the eligible family members and multiplying by per exemption dollar amount as claimed by the filing status. A single filer could claim one personal exemption for themselves. Head of household filers got themselves and could claim each dependent Those filing jointly receive credit for themselves, their spouse, and each qualified dependent. Finally, married filing separately, taxpayers could claim themselves, dependents, and spouses as long as the spouse had zero gross income and was not claimed as a dependent by any other taxpayer. To claim an exemption for a dependent, they must be a qualifying child or qualifying relative. Okay, and there's some phase out stuff here. It talks about adjusted gross income. It talks about taxable income. All right, so there's a couple pieces to this that sort of are the waning notes for the day. It says a personal exemption was available to every taxpayer. It cannot be claimed as a dependent on someone else's taxes. A college student received more than half their financial support from the parents could not claim the exemption for him or herself because his or her parent could claim him or her as a dependent. Whether or not the parents actually did so was irrelevant because the student would have been ineligible for the personal exemption. Was subject to a phase out that gradually reduced the personal exemption of high income taxpayers by 2% for each 2,500 fraction of adjusted gross income that exceeded 261,500 for single filers and 287,650 for head household filers and 313,800 for joint filers. It phased out altogether for taxpayers on the adjusted gross income above 436,300. Okay, so you guys can look through that. It's a below the line deduction subtracted from adjusted gross income to reduce taxable income and ultimately taxes in proportion to your tax bracket. The reduction in taxable income meant its value varied with your marginal tax rate. So if you had 4,015 personal exemption, your tax savings would be across the brackets 15%, 35%, and you would add up those numbers, and the value disparity increases as the income taxes become more progressive. And we're going to go through that. Like I said, trying to explain all this in text here can be a little daunting sometimes. But there you go. Okay, so we had our two topics of personal exemptions and head of household filings. Okay, so we have a video of that, and we'll figure out the next ones. I think tax liability might be next. I'll skim through the married filing jointly. I'll just skim through that next time. Okay, maybe I'll read this out so we hit it. But we've discussed this. That's at the beginning of the course. Tax liability is next. What the IRS actually is, we'll have that discussion on video. Gross income, we're going to talk about gross income. Okay, so kind of get ready for this stuff, right? Read ahead a little bit. You have all these notes, and the notes are in the on Blackboard. Tax deduction, what a tax deduction is. Okay, so we'll go through all that. You got to be prepared. There's no two ways about it. Okay, always save your work as you go. All right, and we're gonna hit this part of things now. Okay, so we're here with this. Okay, now you have this, or you should have this on your it's again, if you go to Blackboard. Oh, by the way, I put some new postings up, or what do you call it? Our October. I should have started the video by saying this. Our October meetings are all the Mondays are YouTube days. Okay, so you guys have that. So yeah, I posted this here, so you guys have something that looks like this. Yeah, why is this all on top of each other? Yeah, that should be spaced out a bit. Okay. Yeah. Okay. So yeah, all the Mondays, the 3rd to 10th to 17th, 21st, 24th to 31st, or and you have to watch all the videos. All right. There's no live meetings those days. All right. All those Mondays. So we're meeting Wednesday and Thursday of all these weeks. Okay. Yeah. So I wanted to mention that, and also just again going to the 101 section. Clicking here, you go to regulation, and you have the what do you call it? Here's the spreadsheets here. Here's the notes. All right, so you guys can reference that, and we have what we have here. So always please you have the template. I mean, you can make your own template if you want, but so anyhow, So looking at this, it says finally whose head of household can provide significant tax savings. So we're here with this. Okay. And if you're individual earning 70,000. Okay, so it says earnings, you're going to type in 70,000. Okay. That's your earnings of 70,000. We're only going to do 2021 today. I'll maybe cut another video, I don't know, maybe Monday or so. We'll do something else. We'll do the next batch of thinking, and we'll finish. We'll do the rest of this. We'll do this 2022 in here also. But again, like I said, you want to be able to go through what are all the documents that you need. You need the 501, the 1040 instructions, and the 505. You have all those, and if you don't have those, you go to the IRS site and you download them yourself, right? So for 2020 returns, which are due in April, the next April, head of household has a deduction, which we already discussed here, 18,880. Okay, reducing the taxable income to 51,200. And then from that amount will be taxed at 10%. And so, so what you're going to do is, and we said this in sort of the text of the course, or the text of describing this problem, your standard deduction here, this is going to be equals negative, and you have that here. You have it listed somewhere, or you should. Audit rates. Okay, we didn't plug those in, but let's plug those in. Here, we'll hit escape. We went through all of this stuff here. We went through all of this. How to get 2021 standard deductions. All these particular numbers. So as you're working this, you want to have your standard deduction numbers listed like this, so you can refer to them. Here, we're right here. I can just copy and paste these, but let's pull them out. So here's this thing. Yeah, for 2021, single or married, 12,550. Right. And then you have married filing jointly, 25,100. Had a household, 18,880, 18,800. Surviving spouse, married filing separately is the same as this. And a surviving spouse gets the for a little bit, right, for 2021, right? You'll get that amount. And here, if you want to really nail down IRS. Yeah, it's in another publication here. It's in 559. Yeah, to the descendant's final income tax return. So yeah, see what it says, if you don't itemize deductions, the full amount of the appropriate standard deduction is allowed. So yeah, that's for survivors, whatever it is, and administrators. So we're gonna need this one. So what I'm gonna do is I'll click on the publication here, and we'll save this. This is 559. This is executors. Survivors. Yeah, that's for your 5 yeah, we don't have that one in there. 551 we have. Okay, so again, if we need that, we have it taken care of. You could say you're using your survivor's version of that for the last year. Okay. And then for 22, it's the 505, and this is 12,950. Right. We just saw that. And this is 12, same one. That would be the same. Single, married, filing separately. Married jointly is 25,900. Okay. And then the surviving spouse gets that number. And head of household is 19,400. Okay. Again, we will reference, this is publication 505. Right, we reference that thing. Okay, that's this. Whoops. Holding us, and this is for use for 2022. This one. So again, estimated tax. It's got to come out. This publication's got to come out a little earlier. Okay. Okay. So we made our table. So we spent the time doing that. Because what you're going to do now for 2021, it's going to be G152. Okay, so this equals negative G152. That's our minus 18,800. There, and we're going to compute what the tax relief is, and we'll compare it to what's stated in here. Um, and actually, we're going to check. I'm looking at this number, what these guys saved, and what the tax relief is, and we're going to do the math. And like I said, that depository of notes, they can be wrong sometimes. So let's make sure what we're doing here. So 18, this thing, yeah, 5,860 is next. So your taxable income, right? After you have your, now this is sort of new to us. You're just adding these two, right? There's your your taxable income is 51,000. Okay. We're gonna look at the marginal rate, the effective tax rate, what the tax bill is. Okay. And also, I think we for whatever reason, I think we just typed it down here. Another way to do it, just 18,800. There's another little detail. You could have referred to it from down here also, which is fine. Okay, head of household again. So for 2021, instead of us retyping the brackets, married filing jointly. Oh, we didn't fill these in. Okay, let's fill it in. Let's fill it in for the 2 years that we have. So it's good. We're working on that too now. Single, married filing jointly, and we'll do in class. We'll do this too. So yeah, it's for 2022. We have it. We want the instructions for 20. This we don't need. We want the 2021 instructions. This we don't need. And there we are. Right there. So jointly, and this is head of household. Okay. That we don't need. And there it is. There's head of household. And it's 10, 12, 22, all that. It's those 10, 12, 22. So yeah, you just saw this in the Trump tax bill, what that looked like. Right. So you have this all in there. Okay. We just, you could retype those if you wish. And we just looked up the standard deduction, 18,800. All right, we did that. And in terms of the brackets are here. So yeah, 0 to 14, 54, and on and on. So 0, 14, 200, 1, 54, 200, right? We're just looking, we're going through these. 4, 201, right? 86, 350, 86, 351, 164, 900, 164, 901, 209, 400, 209, 401. And this is 3. Okay. That's for head of household. All right, you can save this as you go. Okay, that was that one. And like I said, we found the standard deduction for this. And this is the estimated withholdings, how to pay, and all that stuff. So let's find this table here. There's some thresholds. There it is. Okay, so this is, we have head of household, which is right here. We have the head of household, and this is for 2022. Now, actually, we're not gonna work on this right now. So let's see, 2022, 14, 539. Okay, we can work on this next time, because just to make us go back to this sort of again, right? Because we're not working on 2022 right now, so we're just concentrating on 2021. Okay, and then so from here you could just copy these, and now that you worked on it, all right, you can run here. You can run here and do that. Okay. Okay, so we drop those in. We have the 18,880 in there. There. You have all that. Okay, and we just put in the tax brackets. We have this right there. Just copy them. You have your tax brackets. Just copy your tax brackets. Drop them in. Your rates. All right, so you have your rates. This you don't need. Okay. And now from here, not the 70,000, the 51,200. So you need the first tax bracket, right? Amount subject to tax. This is the first bracket. You subtract those. Remember we did this in class? So we're not gonna lose that, this maneuver, and then there's your array is right there. You just multiply the 10% and the 14,200, right? You just use the product, right? It's the product of those, of the percentage and the amount subject to tax. Now the next one, again, you're going up to 51, right? So 51, you're going to grab 51 here. You're going to subtract the previous boundary, and that's going to only give you 37. This can go as high as about 40, right? 54 from 14 is about 40,000. So you're only using 37,000 from that. And this is just the formula. All right, so that's 4,440. So we're right. Okay, and also let's do our check down here. Let's add up, these two levels. All right. This next level here, we're going to add up these two. That's the tax bill is 5,860, and the effective rate is a 5,860 divided by 51,200. and the marginal rate is at 12%. And this, I think we lost a border here. Somebody's asking me about borders. There's your border right there. Okay. That's your marginal rate, your effective rate. And if you come up here, 12, if it's marginal 12%, effective 11.4. So for the legal folks out there, they're gonna be legal assistants, right? Get used to writing paragraphs where it refers to the numbers, and the numbers might change. So 5,860. I could have written this. I could have concatenated this, where as this changes, we can sort of automate these numbers instead of us having to manually go through and change these four numbers. But for this problem, this is good enough. But we can do something called concatenation. We could put a string, we can put a number, we can format the number, and as the numbers change in our tables, we can have the numbers automatically change up here. But I'm not going to necessarily do that today. But we can do that. Okay. All right. This is for 2021. So this relief, where did this relief come from? Yeah. So somewhere, okay, it said it saved this hypothetical taxpayer 2,527. So how did it do that? Yeah, it's subtracted, right? It's subtracted. It subtracted the two versions of the tax bills. Yeah. So, yeah. So what we're doing is we're comparing head of household, right? This is the head of household version, and then we're going to do the single or married separate taxpayer version next, and then we're going to compare those tax bills, and that delta, that difference will be 2,527, which is why you pay people to do your taxes. So I think this is a very basic example, but it's this kind of thing. There's no you have to compute it. To say, oh, well, we're not going to compute it. We're just going to take a shortcut. That's a slippery slope, to put it mildly, to do that. And also, yeah, let's get the tax relief in here. The tax number. How do we get tax relief? Yeah. So okay. So what is this is what the standard deduction gives you. The standard deduction gives you that 11%, which is your effective tax rate, and then 18,000. So if you didn't use the standard deduction, you would have been paying 2,152 more. Now you want to understand, tax relief is not the difference between the two head of household versus married filing jointly. Tax relief is you using the standard deduction or not taking the standard deduction. That's what that tax relief is. And again, and I'll say it again. So this is going to be the standard deduction times your effective rate that you computed. I don't know I forget where that number came from, but it came from somewhere. It came from somewhere in here, somewhere in the discussion. That was the tax relief. Was it in here? I don't know. Yeah, what you saved is one thing, okay? Um, yeah, okay, that's fine. Like I said, so we in Excel we discuss this problem. See what you have here. You're gonna have your let's see, this is 2021, and then okay, this we're all good with all these numbers. Yeah, 1,000 to 240, 440, 4,440. Yeah, so see these numbers here. This is the 5,860 is right there. Okay. And what you paid at 10%, what you paid at 12%. So you tax those two areas. And again, to do this just in your head or this is tough to do just sort of in thin air. That's why we use Excel to do it. Now the second thing we're going to do is we'll do single or married filing separately version of this. Okay, it's the same thing. So we're going to have earnings here. All right, copy earnings, just copy it. Now you're going to have a different standard deduction. Okay, and then you have this here, so pop it in here. So your standard deduction here is going to be a smaller number, right? This will be a smaller number. This will be not 18,000, but this will be 12,550. Okay, and this is, yeah, that's for single or married. Yeah, it's that number for 2021. Okay, it's that. And like I said, we got to fill in the 2022, and we'll do those in future videos. We'll worry about doing that. So we got this far with this. I'm just clearing out, as we're knocking this out, I'm just sort of clearing out the pieces here. Okay. So this table, we worked it out. And again, this is not some Excel table or whatever it is. It's just some borders, okay? And you're creating the table, which is what I've always been sort of preaching to you guys to be able to do. Okay, so the standard deduction here is yeah. So I can say equals negative whatever of this number, 12,550. And then instead of retyping the formula for taxable income, I'm just going to copy it from here because it's the same thing and just drop it in there. And what did this do? It just added up those two numbers. That's it. You just added this number, the row and the column of those numbers. So now your new taxable income is 57,000. Up here it was 51,000. Okay. So you got this is tax relief based on the deduction, but this number here, right? What you're saving, this number is going to be it's going to be the difference between our two versions of everything is what that number is going to be. All right. That'll be the difference in our two. Look at this. Don't worry if it's on purpose that you can't really read this. That's on purpose. So we want to make it just so I can look at it as we're doing this. And just, it reminds me sort of what I'm doing here. Okay. So don't worry about that if you can't read it. Yeah. Okay. So you have that. Yeah, you have the same rates here. Yeah, here you have the same rates. So now now you got a little bit of a bigger taxable income number, right? A bit bigger. Marginal rate will be a little bit different. The effective tax rate will be a little higher. The tax bill will be a bit higher. Yeah, instead of 5,000, it's 8,000 something. Okay. Uh, the income, it's not taxable, but it's the income that your taxable income is a bigger number. Okay. So, and again, you want to get used to when you're gonna never just give someone a table. So, well, understand my table, or understand my math, because that's not believe me, attorneys or whatever, or even wealthy people may not understand this stuff. What they'll understand is a little paragraph that explains what it is. This stuff is you have to get used to sort of explaining what you're doing. That's the difference between sort of mathematics and sort of business. The business analytics that we're showing you here. Okay. And so this is single. So yeah, so we can just come up here, and instead of retyping this, we can pull off that, and we can pull all this, the range of these numbers that we've previously worked on. You could just drop them in there. Okay. And then you can do the percentages for single taxpayer, which is there. So copy. And actually, when we drop this in, I think what happened was I overwrote some of my borders. So what we'll do is for these tax rates, we'll do paste just the values because it's already formatted. Yeah, so see, so you didn't lose your borders in there. Okay. Okay, those are your tax rates, and now you're off and running. And again, your barrier is the 57,000, right? So this is going to be this one, the amount subject tax minus that. This will be this minus because you're in 57, so you're going to be into the third bracket, right? And you guys know down here, you're going to sum in there, right? That'll be summed. 1 second, folks. 1 second. Yeah. So what you have here, you're summing. You want to sum. Obviously, it's your taxable income, which is only 57. I'm saying it's only 40 of the 57. So the next piece has got to be, you're going to equal your taxable income minus the the last, the beginning bracket or the last ending bracket there. And notice how that adds up to your taxable income, 57,450, 57,450. Okay, so you have that. Okay. And now you're gonna do now you have your product. Actually, what you can do is you could just copy and paste these two because there's no anchoring. You can drop them in there and just say Control D, and there you go. All right, whoops. Okay. So this is 22% times the 16, 12% times the 30, and 10% times the 9,950. And you can just sum these. And this is just the same. The effective rate is a little higher, 14 relative to 11%. And this needs a box around it. And you can save it. Okay. So now, so you're paying taxes here. Here your tax bill is 8,388, as opposed to your tax bill here is 5,860. So now the tax relief is the same thing. You take the deduction times the effective rate, and again, you can just reuse that formula here. So again, because you used a deduction, standard deduction, you're saving 1,832. So you're saving a little less, believe it or not, in this particular situation. Okay. Yeah. Okay. So why is that? So yeah, that's a higher number, right? That's a higher number. But the deduction is lower. It's a lower deduction. That's why. That's why this is a lower dollar number. Okay. And this is a little bit higher, believe it or not, this tax rate, but because this is a lower number, that overpowers the higher percentage. And so you want to look at things like that. Oops. Okay. And this thing, the marginal rate is 22%. This is 14.6 is the effective rate. This is 8,388. The taxable income is 57,000. Yeah. Okay. So this is the single or marriage separate version of this. Okay. So there's your now, and then the final number here after doing all this work. Where did this come from? And I'm looking for the math on that. I'm looking to see where I compute it, and I can't find it. So, but you need somewhere you got to have that computation. So I'm just going to throw it up there. We're going to do it like this, just right above it or something. So we're going to say who saved what here. So this was that bill. So this is this minus this. Okay. That's your hypothetical, and let's increase yeah. So it's really just about. So who knows, right? It's 10 cents off, but that's what that is. And that could have been a typo or something. Or what we may have done here is 60 is that one. 838860. And who knows? Maybe I just did the math like this or something. But that's So obviously your tax bill that's that one, and this is 8,388. There is thereabouts that number. Okay, 387. So 995, 3688, 3726 or 23. Yeah, yeah, 3669. Yeah. Okay, so these added up. Marginal rate 22%. So you went at it with you went at this with three tax brackets: 10%, 12%, 22%. Okay, and then the amounts that were taxed, and this is something that people were having questions with. So these three pieces adds up to your taxable income. Okay, so the first you use the whole bracket, use the whole second bracket, and then you use a partial of the third bracket. That's the thinking that has to come into your mind for all this. Okay, you have the tax relief here because it's standard deduction, and then like I said, and we'll do another go around with this. The next video we'll do 2022. We'll fill in some of the tax tables there for 2022. Okay, so we'll do all that stuff. So you saw an analysis today of head of household versus single or married filing separately. You saw that, and you know, there you go. There's how you do everything. Like I said, follow the steps and watch the videos and get the assignments in on time. Okay, folks, we keep saying that over and over again, but that's what's going on. Okay. All right, folks. I mean, this was yeah, this was probably about 50 minutes. Yeah, this is about 50 minutes. Folks, thank you very much, and we'll see you soon.